years when you're a kid.
That's funny.
My daughter, she'll say I'm 8.5.
Yeah,
or
4.5.
6.5, 4.5. It's a big deal when you're in your 90s. You'd say I'm 90.5. I'm almost 91.
Yep, every 6 months counts at that point.
That was
All right. Well, today we have Jason Ronaldo in the podcast studio here. Jason is no stranger to the pod. And today I want to talk about kind of two topics in the news, and we'll go into detail in them. Be sort of a Q&A. Jason will talk smart, and I'll try to keep up. So we've got the two news items are Jerome Powell recently had some statements. Powell's, of course, the Federal Reserve Chairman. So we'll be talking about some interest rates and what the effects of any of those changes might be. And then the other news item that caught my eye was the kind of Berkshire Hathaway story with Warren Buffett. That's his company. This guy is in his 90s, and he has $167 billion in cash at the end of 2023. So we thought, well, why is that? And let's dive into that. So let's get started. Mm-hmm. We'll start with kind of Powell's remarks. Do you have those up, or should I get them up?
Yeah, I got it here in front of me.
Okay.
Basically stated that the Fed is not far from the point of cutting interest rates. Now, we've known for some time the Fed has been preparing to cut rates at some point. We expect this year. It's been pushed back in the recent weeks from when they originally intended to do it. It was originally in March. But then they've been pushing it back further and further. And their comments now is just that they're saying they're not far from the point of cutting. We did a podcast or a video on this last year, maybe the year before. We talked about the pen is mightier than the sword,
right?
And that's very true with what's occurring here, right? The comments from the Fed can move markets. They're trying to telegraph their intentions, and in their view, they're looking at getting closer to their rate cutting period.
Right. So the metrics that they're looking at are, was it PCE? Is that right?
Yeah. PCE, which is personal consumption expenditures. It's a measure of inflation. A lot of times we hear about CPI. We talk about that a lot too. CPI, or the Consumer Price Index. They're both inflation measures. The difference is that PCE tends to be a kind of a more encompassing, broader basket for a measurement of inflation. So that's the measurement that the Fed uses. It tends to track pretty close to CPI. Right now it's about 2.4%.
Yeah, and CPI is at, do we have that number?
Yeah, CPI is 3.1.
Yeah.
And directionally they're moving together for the most part. It's just PCE is their preferred measure. And that's where they've been targeting the 2% level.
Mm-hmm. Yeah, so with that level coming down, we're seeing that the Fed funds rate, which is a rate that drives other interest rates, bank loans, mortgages, car loans, business loans. Mm-hmm. So as Fed funds rate comes down, that often sort of is the indicator or the benchmark.
Yeah, the Fed funds rate is what the Fed uses that's like their main lever to control economic activity. They can try to speed it up or they can slow it down. When they raise rates, they're trying to slow things down to slow down inflation typically. When they lower it, they're trying to speed things up.
I think about the term cost to borrow, right?
Mm-hmm.
So if money is, if interest rates are lower, it's easier, it's less expensive to borrow money for any number of things.
Yeah. So to that point, typically economic activity increases when rates are lower because it is cheaper to borrow. If you're a company looking to expand your business and rates are at 5% instead of 7 or 8%, right? The cost of borrowing just got cheaper and made you more profitable, theoretically.
Yeah, so when Powell is talking about this and telegraphing to the market and trying to prep the market, being his mighty pen, he's saying we're close. We're getting close to either staying at level or cutting, right? Yeah,
cutting, really. And their goal really is they don't want to surprise the market. The market hates shocks. And so they're trying to telegraph as well as they can that they're getting ready to do something, getting ready to make a move. The thing that's been delaying, we've seen some inflation numbers recently that have been kind of a little more sticky. We've also seen the jobs market has still stayed really strong. But I think we're getting to a point, and we would agree with what they're saying, is that we're at a point where they're probably getting close to cutting rates.
I think in his remarks, he had also mentioned the potential for a soft landing, kind of talking about recession. It seems like he's saying we're not expecting a recession at this time, maybe a soft landing, which is a certain type of Fed speak.
Yeah, soft landing, we hear that a lot in the last really 12 months. And the whole idea, the kind of definition or what that means is it's the idea that you're going to basically lower the rate of inflation down. You're going to slow the economy down, but you're not going to trigger a recession. Because a lot of times when the Fed goes through these cycles of raising interest rates, oftentimes like a pendulum swinging, it can kind of swing too far and they can move too much, and it might trigger the economy to go into a recession, which they don't want to do. And so a soft landing would be a good thing. The stock market has largely bought into that, we believe, based on the fact that it's been generally performing pretty well.
Yeah, I think let's move on to our Berkshire story. And as I mentioned, that I think it was a report to investors. There's a newsletter that I think he's been putting out for probably a generation.
Yeah.
So it was revealed, or just kind of known, that $167 billion with a B are held in cash reserves, and that was as reported at the end of 2023.
Yeah.
It seems like a big number, and as a percentage, I think you did the math, Jason. You said it's maybe 15%.
It's around 15% of the assets of Berkshire Hathaway. That's again his company that they now hold in cash. And that cash pile, we say cash, but really what it means is it's short-term investments, things like treasuries. So it's not idling, earning nothing. It's things that are earning, maybe it's 4 to 5%. It's about 15% of their overall assets that are now in that pile of short-term kind of cash type, treasury type positions. Mm-hmm. That's a big amount. And that's been increasing. That went up throughout 2023. They were increasing to that cash pile throughout the year.
Kind of what's the significance of that? So it made news. It does seem like a lot to be kind of holding. Is he waiting for something?
Yeah, that's I think what a lot of people are speculating. And Warren Buffett's got a lot of famous quotes, right? And one of his most famous is be fearful when others are greedy and greedy when others are fearful. And Warren's known for being comfortable on the sidelines with cash, waiting for the opportunity to reinvest, to put it to work in something that's more productive. And so it is, I would say it's not overly surprising that Warren, he's done this in the past where he's built up cash reserves waiting for some better opportunity. And again, he's not one that's hesitant to be on the sidelines.
I think this is an interesting place to pivot or transition just to how do we think about portfolios at Vector? Certainly we have a portion of our portfolios that are held in cash or cash-like things such as treasuries, CDs, maybe some others.
Yeah, to kind of draw some parallels to that, when we think about investing for a client in retirement, we do like to set aside a segment of a portfolio that is in short-term high-quality investments, things like short-term bonds, treasuries, perhaps some money market funds. The main reason being is that the short-term is uncertain. We can't predict with great clarity and consistency, I would argue no one can, what the markets are going to do in the short term, meaning the next 1 to 3 years. And so in our view, it's better to have that pile, that segment of the portfolio set aside so that we can kind of weather perhaps some potential rough spots in the market and not have to sell long-term growth investments to fund short-term living needs.
Yeah, so to maybe draw the parallel or pull on the thread a little bit more, so call it 15% of Buffett's holdings are in that short term. He's waiting for the possibility to rebalance. Mm-hmm. When we're talking about folks in retirement or looking to use their portfolio to fund their life, mm-hmm. That they're different, right? They're similar and different in needs, and we have a finite lifetime. I think you had mentioned that Berkshire Hathaway has been around for years and years and should go on for years and years.
Yeah, that's the big difference here is that although there's parallels between our view, again, making sure we have dollars set aside for the short term for the uncertainty, I would argue that Warren Buffett's doing the same thing. He's viewing the short term as uncertain and that there might be a better time to deploy the cash. The difference is that, for how we think of the short-term dollars, that we're looking at that as distributions to pay for, to send to clients for their lifestyle. Mm-hmm. And yeah, there's a big difference in that individuals have a finite lifespan, right? Mm-hmm. Whereas a Berkshire Hathaway is going to be an ongoing entity for a long time, likely well past Warren Buffett's lifespan. He's 93 years old. Berkshire Hathaway is going to be around for a long, long time, we would expect. Mm-hmm. That's the difference when we think about from how do we want to plan from our client's perspective, is that we importantly have to make sure we're managing around that finite time period, as well as knowing that a lot of times clients have legacies that are designed for purposes beyond their lifespans. But the key is make sure we're protecting what they built.
So we talked a little bit about having some percentage of a client's portfolio in the kind of near term to handle that 2-3 years out. Kind of like Warren Buffett has that 15% of his portfolio is sort of in cash and cash-like. Now I know in the longer term, we also have some of those cash-like investments, treasuries and so on. Why is that? Yeah,
it's a good question. And so there are good reasons to own other types of investments, even in longer term parts of the portfolios. And so that's where, we do own things like bonds, things that are going to help diversify and also help dampen potential market volatility. The other thing too, though, is that we will at some point go through a period of market downturns, right? We've seen that before. We saw it in 2022. We saw it in 2020, right? We will go through those periods. And importantly, we want to make sure, similar to kind of how Warren Buffett thinks about putting dollars to work when things are more attractive, that's what some of those dollars are designed for in the longer term parts of the portfolio, is to be available in there so that if we get opportunities to put that to work at a more attractive entry point, that we have those available. And so that's one of the levers we always think about in terms of rebalancing and putting, like I said, putting dollars to work at a different, perhaps more opportune times.
Right. So just to kind of recap a little bit, we have the 1, 2, 3 years laid out and saying, hey, we know that you got to make those payments and you have things that you want to do with that money. Looking further out, it gets mixed into equities and some treasuries. If one becomes better priced than the other, we make those adjustments. Is that fair to say?
Yeah. Yep. Exactly. It's not just treasuries too. It could be corporate bonds. It could be mortgage-backed bonds. But the idea is that we think of it in terms of you've got investments that are designed for growth, and we have investments that are designed for defense. And sometimes those attractiveness of those can kind of ebb and flow, and that's where we're going to want to have the ability to pivot to one or the other depending on market conditions.
If and when Fed funds rate comes down, that he's not earning quite as much. Maybe he doesn't care because he's just sort of waiting it out, waiting for those opportunities. As we think about, who gets hurt when Fed funds comes down?
Mm-hmm. Yeah, so one of the more, negatives of when rates come down is that the interest that we can earn on our savings accounts, CDs, the things you see in your bank account, money market funds, that's going to come down as well. And so as the Fed starts to lower rates, we're going to earn less on our cash savings portion. Now, there'll be a lag effect. It won't be immediate once the Fed starts cutting rates, but we can expect that savers, again, cash accounts, CDs, short-term treasuries, the yields available on those will come down. And thinking to Berkshire Hathaway and Warren Buffett, there's a connection, there's a direct correlation between what you can earn on a short-term treasury, if it's 5.5%, versus putting it to work buying a company. So there's a trade-off happening there. So when the rates come down, it gets to be perhaps less compelling to own cash and perhaps a better trade-off to invest it into another business. So that's going to be some of the kind of the weighing that will occur across the entire economy.
Right.
Warren Buffett and Berkshire Hathaway is one example of that. But there's always a trade-off it comes to when people are putting money to work, whether it's holding it in cash or investing it for longer-term purposes.
Yeah, it seems like there's an interesting connection just between that, the savings versus investing, and then just trying to make those decisions around, where to be and when to be, and
that's the balancing act of both companies and individuals.
Yeah,
and importantly on the individual side, as we hit on, is that there's a finite time period that we're dealing with, and making sure that we are thoughtful about how we plan for those environments, because while Berkshire Hathaway might be able to go through a severe or a drawdown in the market and come out of that because it's going to be around for the next 100 years, individuals will experience that differently, and we want to make sure that as we go through market cycles, that we can defend against that the best we can and still capture upside on the other side of it.
I think that's a great spot to leave it. Thanks, Jason, for coming in, doing the pod. It's been a pleasure.
Thanks, Ezra.
Yeah, see ya.
See ya.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Be sure to consult first with a qualified financial advisor and/or a tax professional before implementing any investment strategy.